And hope you all are having a fantastic beginning to your Tuesday, the last day of January, which is totally crazy. I have no idea where January went. We are truly very excited to have our first monthly webinar. This will be a series that we will be doing every month on the last Tuesday of the month. A quick 30-minute, really interesting, digestive overview of, all topics of family finance, in which we will dive in to hopefully the most important questions and really tap into everything that you all have been asking about, wondering, wanting to explore, dig in further. The goal here, though, is that I know this is 30 minutes of your busy day. I want this to be fun, interesting, interactive. I do not want this to be a normal webinar where you sit and just listen and watch. So we've got some fun questions and just ways to participate that hopefully make this really enjoyable and that you walk away with both some clear knowledge on some of these key questions that we've proposed for today's session, but also that you feel energized and charged up for a great rest of your week. So we will kick this off starting now. And again, welcome for those that just joined. I am Jordan Wexler, the CEO and co-founder of EarlyBird. It is so great to be able to meet you all in person now. One of our goals in 2023 is community building and really bringing together all of these amazing parents that are on our platform that are maybe just starting to invest or have been investors for many years, or maybe just starting to invest in their kids, or maybe expecting parents. It really runs the gamut of amazing families, but we all have one major singular goal, and that is to build a better financial future for the next generation. So let's get started and jump into this month's topics, which is the 5 questions every parent should ask when they are starting to invest, especially today in a climate that is pretty uncertain. I think everyone's feeling it in different ways, but there's potentially a looming recession. We just don't really know all the answers through 2023. So it's critically important that we look at and know what we are doing, what we're investing in, and we have the answers to some of these key questions. So number one that we get asked a ton is really, what is the difference between a custodial investment account and a 529 plan? So we are going to dive in. Number 2 is dollar cost averaging. Why is it important? What is it? And how can I ensure I'm doing it correctly? Number 3 is diversification. When you're looking at your portfolio, again, this isn't just about your child. This is really about understanding from an entirety, when you're thinking about investing, how do I diversify my portfolio and my different assets? Number 4, how can I maximize the power of compound interest and minimize taxes where possible? And then number 5 is, what are the most important things to be aware of during this potential recession and what we are in right now, which is a bear market. So very excited to get started. American families right now, unfortunately, are generally set up for some major challenges over the next 5, 10, 20 years. The biggest reason that we believe at EarlyBird is that 66% of American adults consider themselves financially illiterate. I think it's a really horrible question to ask, but have any of you taken a class on financial literacy throughout your entire childhood? Generally, 90% of us would say no. I know I didn't personally. That is through high school, college. So these are just topics that are not talked about enough. Unfortunately, there's always been a stigma around money and finance, but luckily that is being greatly transformed over the last 10 years. And we are now at a point where there's so much information available to us that it is critically important we both take advantage of that and we share that with our kids. The wealth inequality gap, though, has never been larger. The top 1% are making the majority of wealth, and middle class is really being minimized, and lower socioeconomic class is in a lot of pain right now. And so it is so important for us to all begin and think through how can we invest and put our money to work. So the basics, let's quickly review this. On the right side, you'll see some investing tools that we think are really important beyond EarlyBird, right? EarlyBird is, of course, to start investing in your child and ensure that they have the best financial foundation. But that's not the only thing that's important. What else is important is that you are building your own financial future as a parent so that you are setting the right behaviors for your child as they grow up. Some tools that we are interested in, and have also partnered in different ways, is Wealthfront. It's a really great place to, for an individual to begin their investment journey. They have a lot of good fixed managed portfolios, same with Betterment. Then you have Robinhood, which is, of course, a self-directed investing platform. So if you want to take more control over those investments, you can do it. Zeta is the top left, which is actually a parenting or couples tool to manage budgets and your balances. Mint is a really good consolidation of a lot of great banking, of all your bank accounts, so that you can oversee your balances and ensure that you're on budget. So the bottom right are some learning resources, some of my favorite podcasts. Highly recommend them. We will be sharing this deck, of course, after this presentation, and you will be able to dig in further. But some of the key checklist items that we want to go through is, one, getting started as soon as possible. This is one of those topics that everyone starts to dig in, and you can get to analysis paralysis, where you look at so many options. What do I start? Where do I start? How do I begin investing? The most important thing is that you find what you feel confidence in and begin today, because we'll get into the power of compounding interest. The second, of course, is really making sure that you have your budget and you know how much you can put away on a monthly basis to be invested, so that you are not feeling the pressures and struggles of everyday expenses. The third is trying your best to avoid consumer debt right now, right? If that is maybe you're looking at buying a car that is a little bit out of your budget, right? That interest rates are much higher, to just be really strategic in how you're thinking about that. The fourth is to build a thesis. What do you want to invest in? What do you believe in? What are you looking at long-term for the next 10 to 20 years? And then make sure that that thesis is created so that you can create and invest in a diverse set of assets. And then lastly, as we are all families on this generally, or parents, make sure that you begin that conversation with your kid from day one, as early as possible. Our children are sponges. They both react to what they see, but they also listen deeply to what we share. And so we highly recommend beginning that conversation around money. What is it? Why is it important? What are we investing in? Because it can change their lives. So the first question of the 5 that we are focused on is the differentiation between a custodial investment account and a 529 plan. We believe these are two critically important investment vehicles in your larger portfolio. One is not better than the other. It's so important to understand that. It is more about your preference as a parent, that you're looking at the future. Do I look and think that college or higher education is the most important thing, and am I most worried about that expense coming up? Then a 529 plan is most likely a really good place to start. Now, a 529 plan is a state-by-state investment vehicle that, depending on the state you live in, you want to look into, and that is an advantage because any investment that goes in there, you can spend on higher education, and it will be fully tax exempt. So any of the gains that you made, say you put $10,000 in over the next 18 years and you made $8,000, that full $18,000 will be able to be spent towards tuition or other necessities, part of college, but now even high school, and they're getting a little bit more flexible on what exactly it can be spent on. So it becomes a really great tax advantage vehicle. The one challenge with that is that it is very limited to what it can be used for in today's world. So higher education, as I mentioned, is the primary purpose. What is good, though, is that you can also actually move it to the beneficiary. So if say your child chooses not to go to college, but you have another child, you can move that over to them and you can use that for their college expenses. The other limitation is what you can invest in. These states generally have packaged plans, so you have a lot less flexibility in what you invest in. So that's a 529 plan. A custodial investment account is a really great vehicle for parents that aren't sure what their child's going to have and want complete financial flexibility. So a custodial investment account you can literally think of as an investment account for your baby that will end up becoming their primary brokerage account. So just like you might have an account with a Schwab or with Wealthfront or with whatever platform, you're starting to invest from the earliest age, and then they will take control of that and be able to use it for anything they want. They can, of course, use it towards college, but they can also use it to buy their first home. They could use it to maybe, for their first or hopefully only wedding. They could use it to travel the world. There's a lot of different applications that they can end up using that for, and it gives them a lot more financial freedom. So at EarlyBird, we focus today on custodial investment accounts as a great starting block. But again, this is really about your thesis and what is most important to you when you're thinking through what am I saving for and what am I most stressed about in the next 15 to 20 years with my kid. So the next super important question is, what is dollar cost averaging and how do I take full advantage of this? It is generally a pretty simple concept, which is that, as you can see on the right-hand side, one lump sum investment of $8,000 starting in January, and you go through 8 months, the market would fluctuate. So the cost of the stock that you buy for $10 might go up in February, $14. So you've made, decent return, but then drops to $9, back up to 13, then 8, 8.5, 7.5. And ultimately by month 8 in August, you've averaged out to $10. So you've actually made basically $0 on that lump investment. If you focus on dollar cost averaging, that is thinking through putting in a specific amount that you can afford on a weekly or monthly basis and being able to not focus on timing the market, right? Markets go up and down. That is historically how it's always been. But if you are investing consistently, you will see that if I invested $1,000 every month, January, February, March, April, May, June, July, August, that instead of timing it with one lump sum, I will have actually bought on the up and the down and ultimately averaged that out so that when month 8 arrives, I've actually now made a 4% return on my funds. So that is why we highly recommend EarlyBird and for all of your investing strategy to focus on dollar cost averaging. Almost every app out there allows you to really easily set a reoccurring investment. I personally look at doing this on a weekly basis because it's even better, right? Smaller amounts, but you can track and really average out the gains and losses throughout an unpredictable market like we're in right now. But you could also do it on a monthly basis. You can do it on a quarterly basis. It's really up to you. But the principle of it is that nobody can time the market. It's an impossible task. And this really helps you to stay consistent and to avoid the idea of the emotional aspects of, oh my God, the market just dropped 20% like it did in 2022, right? That is not a consistent worry for you because you are not about timing the market. You are about long-term investing. So hopefully that's very clear and a strategy that you can take not only to your own investing, but of course also to your child and thinking through the next 18 years, which many of us have. Question number 3, what does it mean to diversify a portfolio? So diversification is so important when we look at investing as a whole, right? What is diversification? That is the idea that instead of going all in one idea or one investment strategy, you are looking holistically at where and how can I put my money to work and ensure that I am investing in a lot of different areas because I'm unsure what is going to win in the next 20 years. So part of this is understanding what is an ETF, an exchange traded fund. So at EarlyBird, we focus on ETFs. All iShare ETFs, which is under BlackRock. And we do that because instead of investing all of your money, say, in Netflix or a specific company that is much more prone to volatility, as we've seen in the last year with the tech industry and some of the major drops in companies like Amazon and Google and these companies we thought would always go up. Unfortunately, depending on the economic climate, they might not. And so what we look at is something called ETFs that are baskets of stocks. So instead of going all in on one, ETFs take industries or the S&P 500, the top 500 traded stocks, put them all together, think through the different percentages weight of each stock, and then allow us as individual investors to now invest $100 a month into that ETF, which is a basket of these stocks. That allows us to really diversify our investments and not go all in on one. You also can then think about this from an industry perspective. So if you think, energy is going to be a key indicator over the next 5-10 years, there are energy-based ETFs. Or if you think technology is going to continue to take off, cybersecurity. There are all these different industries that you can go in on, and there are ETFs made up of many companies that you can then invest in. At EarlyBird, we look at broad scale ETFs. So we have large cap, which are S&P 500 companies, small cap, which is a lot of the smaller companies out there that have 5,000, 6,000 companies under this one ETF, international, emerging market, and bond-based ETFs. Then when you're looking at how do I want to invest, it is so important to understand 3 key items. The first is your risk tolerance, right? Where am I on the risk spectrum? 2022 was a tough year. Did it scare me? Did it give me anxiety every night I went to bed and I had nightmares about it? Then that means you're on a very low risk tolerance, which means you want to be very safe with your investments. That might be something looking more into like the bond world, as bonds have a lot less fluctuation. They might have less return, but they're safer investment in the long run. If you are on the more higher risk tolerance, you can definitely, and 2022 wasn't a major fear of yours because that historically the stock market has seen about an 8 to 10% return over the last 100 years. You definitely can lean into the more aggressive side of your investing thesis. Lastly, is that beyond just the stock market, there are a lot of other ways you can diversify your investments. Some of the things that we look at are investment vehicles. So as I mentioned earlier, right, you have a custodial investment account, a 529 plan, but then you can also look at real estate. You can look at private markets. There are a lot of other ways to put your money to work that we highly recommend exploring, because the bottom line here is that the buying power of $1 today is significantly going down through something, of course, you all have heard, through inflation. So if you see the bottom right, $1 in 2010 is today worth about 69 cents, right? It's decreased about 30%, which means that if your cash is only sitting in your bank account, it's not being put to work. And it's important to reevaluate how much you are investing and when and where you're doing it. Question number 4, how can I maximize the power of compound interest? So this is all about time, right? Time is the most important thing when you're thinking through investing and how much you want to invest and when you want to invest, which is all about starting today. As you can see on the left-hand side, we have 2 wonderful characters. You got Jack and Blake. Blake started to invest around the age of about 30 years old. And Jack started right after he was 18. They invested the same amount month over month. And as you can see, by just about an 8-year difference, Jack has almost doubled the value of his investments at the same age, 67 years old, right around retirement, than Blake did by waiting 8 years. So this is such an important graph as we think about long-term investing. As you can see here on the right-hand side, if you invested $20 a month starting at day one for your child, how much do you think they would get when they were 18 versus 60 versus 70? So at 18 years old, they would have about $12,000. At 60 years old, you're looking at almost $1 million. That means that if you started investing today in your child just $20 a month, and you stayed consistent, by the age of 70, when they're basically hopefully fully retired, they would have almost $2.5 million to be able to retire on, fall back on, and be able to, hopefully continue to live the life that they dream of. We always like to compare this to practical examples, which is a crazy, over-expensive dollar cost of a coffee today, which is now actually more than $5, but that is one coffee a week, right? There's always that one thing that you can think about minimizing from your life that will actually have this incredibly large impact long-term in your investment strategy. So the last question that we will wrap up with is, what are the most important things to be aware of in a recession and during a bear market? So curious to know, who knows what a bear market is, and if we are in one, and what you all think about that. Unfortunately, what a bear market is defined as, on the right-hand side, is a 20% dip in the actual market defines when we enter bear market territory. It's the same when the market increases 20% to reach a bull market. So in 2022, we reached a bear market that we, though, have actually reached over 26 times since 1928. So this is common, actually, right? The market goes up and down over time, yet the market, since about 100 years historically, has averaged out a gain of 8 to 10%. So even through these bear markets that the market dips, right? 2008 was another big example of that. We've always seen a correction back and a significant increase, because the average amount of a bull market is about 36% increase to the market. So it's so important to get that perspective of understanding that the market will go down as it did in 2022. But again, historically, we are not predicting the future, but historically, the market will return to a bull market, and you will be able to see continuous gains, year over year. What is so important is to think back to dollar cost averaging, right? There is no timing the bear market or a bull market. So if you stay consistent, you will be able to take advantage of all of this. The most important thing, though, during a bear market is to remember keeping your fears in check, right? Liquidating all your funds and running, is a strategy that you can take. But again, it's all about time horizon, right? How long are you investing for? And do you have the ability to wait through a bear market that averages for 20 to 36 months is the average bear market time frame? And can you wait through that? Continue dollar cost averaging. Play dead is a really funny one, in the sense of don't check every day. My father always said, when the market's down, just don't look, right? Don't look at it. Don't continue to check every day, because it'll increase your anxiety. And you definitely, don't want that pressure on you. As it's important to, of course, check your investments, but on a daily basis probably isn't the smartest idea. Continue to think through how you can diversify your investments. Also, though, what is so important is your budgeting, right? Only invest what you can afford to lose, because most of the time when your investments are now in the market, they're still liquid, as you can, of course, liquidate them and be able to use them, but it's not the same as, of course, in your bank account. So when you have to pay your rent, you always want to make sure that you are balancing out how much cash on hand do I need, especially during maybe a a more difficult economic climate like we are in right now versus what can I put away. And so you can fluctuate dollar cost averaging, right? And in the good times, you can maybe be investing $100 a month. In more tough times, maybe it's $25, but you can always fluctuate that. And then lastly is thinking through what are defensible industries, right? During a bear market, it's not like everything crashes generally. In 2022, what was hit most was tech stocks, but a lot of other industries weren't hit as bad. So how do I explore those? What do you think long-term are things that are going to be required and in need in our economy? So those are the 5 major questions and answers. Hopefully very helpful for all of you amazing parents out there. I know that we have just a couple minutes left, and I wanted to give an opportunity for everyone to be able to, if you have any questions, be able to ask them and open it up live to all of you, which again, we are just so thankful that you joined our first webinar. We'll be sharing this, of course, right after this presentation, and you'll be able to review those slides as well. So you can ask the questions on the right-hand side easily if there is anyone that wanted clarification on any of these topics and to dig in. We got one here. What's the financial institution that manages the funds invested? So at EarlyBird, we work with a lot of different financial institutions. The biggest one is BlackRock. So BlackRock is the financial institution that we collaborate with to actually construct the portfolios of within EarlyBird. So they're all iShare ETFs. And then on the back end system, from a technological standpoint, we work with a company called Apex Clearing. And Apex Clearing powers all of the biggest brokerage services out there like Acorns and Wealthfront. So we definitely have chosen the best in class financial institutions to ensure that every parent investing on EarlyBird is investing in a safe and credible manner. Any other questions? Oh, there was one about crypto. So crypto investing is, of course, a fascinating topic, and we will have a lot of messages. We will have a fully dedicated webinar with crypto. So we work with EarlyBird. We've partnered with Gemini, which is a really great crypto exchange, one of the top ones out there. And we will actually have them come to the webinar to interview them, do a little fireside chat, and discuss all things crypto. So that actually might be next month. So keep your eyes open for what the topic will be next month. But crypto is definitely part of the diversification concept, right? When you look at all of your money, I can invest $1,000 a month. How much of that is going towards ETFs? How much of that is going towards individual stocks? How much of that is going towards crypto? How much of that is going towards other investment asset classes that you're looking at, right? And that's part of your thesis. Do you believe in crypto? Do you believe in the technology? Have you done your research? What coins do you believe in? Bitcoin or Ethereum or beyond? These are all super important questions to explore and ensure that you have learned enough before you go all in. That's one of the most important things about investing is don't just follow the hype, but really follow your own intuition and your own education so that you can make informed decisions. Are you going to be in Canada? Soon, hopefully, really soon. We have so many asking to expand to Canada. It's a big expansion, but we absolutely have that on our agenda. So hopefully soon. And Brazil. That might be a little bit longer down the road, but a couple years, we are hoping to be much more global. And Japan, that would be phenomenal. So we know it's 1 o'clock. 30 minutes, hopefully a little bit of your day just to jump in, learn something new, hopefully gain a little nugget of information here and there. Thank you all so much for taking the time. We deeply appreciate it, and we're excited to see you next month. Have a wonderful day. Bye-bye.